Good afternoon. My name is Fred Van Dorp. I'm the Budget Division Director with the Department of Local Government Finance and would like to welcome you to the presentation today. The department is in the process of releasing the 2023 actual circuit breaker figures and posting those on our website. So this becomes another opportunity for us to discuss the circuit breaker. As the slide shows, this will be the third time that we've discussed this in the last 3 years, each time from a slightly different perspective, and we'll take a look at that here in just a moment. But there's a question of, is there still that much information to discuss as it relates to circuit breakers? And hopefully over the next 60 minutes, we'll be able to demonstrate that the answer to that is yes. In 2023, the department certified budgets that are going to be funded in part by $9.9 billion of projected property tax revenue. The circuit breaker for 2023 is about 1.1 billion. So about 11% of the total amount of property taxes expected are going to be lost to circuit breaker. So we can see that with that, and while that will vary based on unit, while that will vary based on county, we can see how important circuit breaker is to managing the amount of property tax or setting expectations for how much property tax you're going to collect, which in effect is making sure that the budgets that we worked so hard to pass last year remain funded, or we can avoid any surprises throughout the year. In the first webinar of the series, we defined what circuit breaker is and then traced the circuit breaker back to its origins on the tax bill. The link on the page is to that 60-minute webinar. Last year's webinar, we started to examine the relationships between circuit breaker and budgeting, examining how the department comes up with an estimate every July, how the units include the circuit breaker estimates as part of their Form 4B as they're working in the budgets. And then we went as far as to review the actual report, the circuit breaker actual report that the department releases in April or May. And then the importance of reconciling between those two, or keeping an eye on, or those three documents, and keeping an eye on the totals that were incorporated versus the actual amounts are available, and how to consider adjusting your spending accordingly. Today's webinar is dedicated to a very specific topic, and we're going to look at how each unit's portion of the circuit breaker is calculated and each fund's portion of the circuit breaker is calculated. Specifically, we're going to be focusing on circuit breaker bucket, circuit breaker or circuit breakers related to the 1%, 2%, or 3% property tax caps. And we will only very briefly touch on circuit breaker associated with the over 65 circuit breaker. We're going to discuss that during the frequently asked questions at the end. So as we go through this, any reference I make to the circuit breaker or to the calculation, we're only focusing on the actual bucket circuit breaker. Okay, and so to do that, we're just going to work through a very, very short agenda. We're going to start off by sort of establishing a baseline. We're going to talk about traditional property tax collections and distributions. We're going to examine a property tax bill that does not have any circuit breaker at all, so we've got something to compare our later more complicated calculations to. Later, we're going to start examining circuit breaker we're going to examine 3 more tax bills as we look at protected, unprotected, and exempted funds. And finally, what the entire presentation is building towards, we're going to take a look at a couple of frequently asked questions to sort of tie what we've covered on the previous slides to the relevance of how we apply this to the budgeting process. With that in mind, let's start with, let's work to establish our baseline. And so what we're looking at, the picture on the screen, is a excerpt from the DLGF certified budget order. Traditionally, units are going to use the budget order primarily for two pieces of information. One, the amount that's listed in that certified budget amount represents the unit's approved authority to spend in the upcoming year. And so in this case, for this township that we're using as an example, they have $77,000 worth of spending authority. The other total that gets used on this document, or is the primary use of this document, is that 41,000. That 41,206 is the expected amount of property tax collections that the expected amount of property tax collections. If we go one step further, if we look at the relationship between the budget and the levy, we know that of that $77,000 of spending, 41,000 of that one is going to be tied to property tax collections or expected property tax collections. The remaining portion of the budget is going to be funded by both cash on hand and non-property tax revenue. For the purpose of this presentation, I actually want to focus on the number in the middle there, the certified AV. That AV, that $246 million figure is doing a lot of heavy lifting. That number represents all of us, the places we live, the businesses that we run, the places we frequent, how the unit will generate that $41,000 in order to support that $77,000 worth of spending comes from the individuals who'll be paying taxes valued at the 246 million. And so that 246 can be looked at as both what's the area that will be paying the taxes, and another way of looking at it is what is the service area, who will be benefiting from that general funds spending, who's going to be paying into and then benefiting from that township assistance. But there's more that we can take a look at. While presented as a single figure on the budget order, the tax base can be broken down further into different geographic areas. The screenshot on the screen is an excerpt from a report on the public side of Gateway. What this is showing us is that while the 246 is the tax base, is the service area for that township, we can further break that down into two smaller subsections, Taxing District 9 and Taxing District 10. The property tax owners, when they receive their bills, when they pay their bills, will be funding the general fund for this township. Now, in addition to certifying the funds, the budget funds, levies, and tax rates on the budget order, the department also certifies the aggregated amounts for each taxing district, and we include that on our budget order. So what we're looking at here is an excerpt from that table that we put into our budget orders, and here we can see both taxing districts 9 and 10 and the total aggregated rate. Now, what's being aggregated? Every fund that has the ability to levy over that $246 million figure that we looked at before will ultimately be considered as part of the tax base and will ultimately be part of the tax bill that's generated and sent to those individuals. Another way of looking at it is in a more detailed way. And so in Taxing District 9, here are all the individual funds that are going to be made up that comprise that particular taxing district. The total value of the taxing district rate is 1.513, but we can see that includes a portion for the county, portion for the township, portion for the school corporation, and the library. I want to keep a sort of a special eye on that township number. If we were to compare Taxing District 9 and Taxing District 10, what we're going to see is that both taxing districts are paying the same county rate. They're paying the same township, same school, same library. The only difference between these two taxing districts are the individuals who live in taxing district number 9 do not receive services from the town of Cherubusco, and the individuals that live in taxing district 10 do receive services from Cherubusco. And so the total taxing district rate for taxing district 10 has all the same underlying components as taxing district 9, plus the rates associated with the fund, bringing their total taxing district rate to 2.2754. A third way of looking at that information would be if we compared and contrasted the total rates in taxing district 9 and 10. We can see that first row, both taxing districts have a total county rate of, or paying a total county rate of 0.4138, a total township rate of the 0.907. What's important here is the percentage of the rate that the unit represents. In taxing districts 9 and 10, the township is the same value of the 0.907, but in taxing district 10, that 0.907 represents 4% of the total rate, whereas in taxing district 9 represents 6% of the total district rate. So why is that so important for discussing circuit breakers? When the bills go out, they're going to show the total taxing district rate. When the money comes back in, the money is going to be distributed in a two-stage process. Stage one, we're going to look at what percentage the unit represents of the total taxing district rate. In step two, we'll be looking at each fund's percentage of the total units rate. And in using this two-stage calculation, when the money comes in, when the money is collected locally, your auditor is able to distribute specific dollar amounts tied to specific funds. But let's take a closer look at that. In this example, we're looking at two tax bills simultaneously. So on the left-hand side, we're looking at a tax bill for $500 in taxing District 10. On the right side, we are also looking at a tax bill of $500, but this time in taxing District 9. And so in the upper left-hand corner, we're going to see those same percentages that we saw earlier, where the township represents 4% of the tax rate. So the township can receive 4% of the $500 that was collected. And so in step one, what we're going to do is we're figuring out how much money is going to be ultimately passed to the underlying units. If we compare that to the upper right-hand corner, the step one for taxing District 9, it's the same $500, but the township in this case represents 6% of the total. So the township is going to end up receiving $30 of the distribution instead of 20 if we compared it to its neighbor. In the bottom left-hand corner in step two, now that we know that the township is going to receive $20 of distribution, we can now take a look at all the individual township rates and figure out what percentage each one of those rates makes up of the total. So in the bottom left-hand corner, the general funds rate represents 18% of the unit total. So the 0.0167 divided by the 0.907. Because it makes up 18% or 18.4% of the total rate, it is going to get 18.4% of the $20 that's available, which is how that $3.68 is calculated. If we go down to Fund 1111, it makes up 39.4%, and so it ends up getting $7.89. And so this is the calculation that we'd ultimately end up performing to figure out how much money each unit gets and then how much each fund gets. In the bottom right-hand corner, we're going to go through that same process. We can see that the township rates have not changed, and so we're going to go through that same process, except it's going to be tied to that $30 figure. So just a quick summary. What we have here is that the department, as we're going through the budget certification process, is going to identify certify budgets, levies, and tax rates at a fund level for each unit. The department's also going to aggregate those to the taxing district level, overlapping each one of the overlapping tax rates at a taxing district level so that everyone in a geographic area is paying the same rate for the same services they're providing. When the tax bills go out and come back in, the money collected is ultimately going to be distributed using that two-stage process. So we are 16 minutes into a webinar presentation, and we haven't yet looked at circuit breakers. I think it's important that we establish this baseline when circuit breaker doesn't exist so that we can see how the general flow of money occurs. From here, we're going to add more complexity in each example we've taken a look at so that we can see how the revenue collected is ultimately going to be calculated, along with the circuit breaker losses are going to be calculated at both a district and a fund level. All right. So as we transition to the next next idea, I think it's important that we sort of expand our definition of, apologies, let me back up. In the previous section, we were focusing on how the revenue was collected. If we are looking, as we transition that through the rest of the presentation, what we need to take a look at is how not only is the revenue collected and distributed, but if circuit breaker represents an uncollectible portion of the tax bill, what we're trying to identify is, for each unit and each fund, what part of this uncollected amount, what part of this circuit breaker loss is going to be applied to each unit and at the fund level. In order to do that, we need to have a conversation about prioritization. In our next three examples, we're going to take a look at how circuit breaker works in one of three different ways. And to do that, we need to sort of expand the definitions that we're currently using. And to do that, I'd like to do it in sort of a reverse order. For the purposes of this presentation, any reference made to a concept of exempt or exempted funds, that is a shorthand for describing referenda, whether it be operating capital or school safety, whether it be for a municipality, a special district, or a county. Exempted funds, when we're saying that, we're talking about referenda funds. For protected funds, for this presentation, any reference made to a protected fund we can use that as a synonym for just simply a debt fund. All the debt funds are protected, all protected funds are debt funds, which leaves us with the ones marked standard, or we can consider those to be unprotected. For that example, what we're looking at is literally every other fund. If you're not a referenda and you're not a debt, you're considered standard, or you would be considered unprotected. Every fund, or for the 23 budget cycle, the department certified 11,000 funds. Every fund can be matched to one of these three identities, or one of these three designations: unprotected, standard, protected, or exempted. And we will see that as we work through these examples, that designation will help to prioritize which funds are impacted by circuit breaker. In our first example, we're going to be pretending as if there are no protected funds and that there are no exempted funds. So no referenda, no debt. We're just looking at our sort of introductory example. Now, in this process, we're still going to go through that same two-stage calculation that we looked at for a tax bill that had no circuit breaker loss. And that's what we have here. So we're still going to be looking at taxing District 10, and we're going to see a lot of the same numbers that we saw in the previous version, but I really want to draw attention to the column labeled unadjusted tax bill for $500. In our earlier example, that's what we used. We figured out that for a $500 tax bill, this unit's percentage of the total tax rate was 4%, which would have equated to the $20 distribution. In this example, now that we're introducing circuit breaker, what we're going to evaluate is a tax bill that should have netted 500. Instead, is going to be a tax bill that's only going to generate $400 of revenue and is going to generate $100 of circuit breaker loss, right? And so I wanted these totals to be included all on the same slide so that we can see what would have happened if there wasn't circuit breaker, and how both the circuit breaker revenue gets generated in the column with the 400, and the circuit breaker loss is going to be allocated when we look at that particular column. Okay. So just as before, when the 500 came in, 4% of that was allocated to the township. In this example, of the 400 that comes in, the same 4% is going to be allocated to it. The circuit breaker loss associated with the unit is also proportionally calculated. If there's $100 of loss, then the township makes up 4% of the total. What we're going to see on the next slide is that we're going to have to figure out of that 4% of that $4 that's tied to the township, how is that going to be allocated further at a fund level? So just like we saw before, and now we're looking, after we figured out how much revenue and circuit breaker is going to be applied at a unit level, we're going to take a look at the individual's units tax rates to figure out what percentage they're ultimately going to get of that circuit breaker loss. Just like before, the general fund makes up 18.4% of the total unit rate. On the unadjusted bill, that meant that they were going to receive $3.68. On the circuit breaker adjusted or the circuit breaker credited bill, they're ultimately only going to end up getting $2.95, along with 74 cents of circuit breaker loss. So the same process that we used for calculating the original bill when there was no circuit breaker, we're applying those same concepts to both the revenue that came in and the amount of circuit breaker loss that's associated with the unit. as we repeat this on every tax bill within every taxing district, ultimately we arrive at those total circuit breaker loss for each fund that we'll end up posting online. Now, I want to point out here that in this example, where there were no protected or exempted funds, there was no prioritization that was worked into the calculation. All funds experienced circuit breaker at the same time and in the same calculation. In other words, we didn't empty one bucket before emptying another. Simultaneously, every fund for this unit was impacted. We will be able to see how that is different when we start taking a look at examples 2 and 3. In example 2, we're going to introduce the idea of a one protected fund, or we're going to introduce the idea of a protected fund, but our conceptual calculation is still going to work the same way. We're still going to go into this two-stage cycle. Before we look at the math, though, I want to take a moment to stop at our actual circuit breaker report. Off to the far right, we've got two columns where at a fund level we are acknowledging which funds go into receive this the protected designation. And so whether we're using the fund's name, whether we're using the smart numbering for the fund code, we're ultimately when the department posts its circuit breaker report, this column to the far right, this one that's with the yeses and the nos, are how we can see exactly which funds would receive the protection and wouldn't be. Now that we know how to find it, let's put a much more specific definition onto what is the value of this protection. What we'll see in the math on the next few slides is that for protected funds, for debt funds, they won't experience circuit breaker until won't experience circuit breaker until the protected funds are exhausted, meaning when we start to apply circuit breaker, we're going to apply that circuit breaker to any fund that's not protected. And once those funds are exhausted, then we could potentially apply it to the protected fund. So when we're talking, when I keep saying prioritization, in our first example, there was no prioritization. All funds were reduced simultaneously. In this next example, we're going to see how protection prioritizes which funds are funded first and which ones experience circuit breaker first. To do that, let's switch from looking at the township we're going to look at a different unit. So in this case, we're still using the same totals we have before. This is still our original example, but let's transition away from the township and take a look at the county. Now, for the county, they made up 18% of the taxing district rate, and if there were no circuit breaker, if the bill came back with $500 on it, the county would collect $91. In this case, because only $400 of revenue were actually collected, the unit's going to get 18% of that 400, and ultimately that will tie them to the $73 and $18 of circuit breaker loss. So far, this is just like the original calculation. The protection doesn't impact step 1. The protection really starts to come into play on step 2. So if we can just picture that red box up one row, I want to focus on fund 0283, the fund that's marked protected, the debt fund. Just like we did with the township, we can see that the tax rate is 0259, which represents 6.26% of the total rate. The way the protection will be applied is we are going to ignore that rate for the unit during step 2. And so that's what the column labeled percentage of TU rate or taxing unit rate without the protected fund. If we took the debt fund out of the calculation, right? If we deprioritized circuit breakers going to that fund, instead of getting 6%, instead of the debt fund getting 6.26% of the loss, it's going to get 0% of that circuit breaker loss. But the loss has to go somewhere. And so if we go to the top of the page, in the original calculation, the general fund was going to experience or represented 68.66% of the unit's rate. When we take the debt fund out, the general fund now represents 73.24%. The circuit breaker went away from the debt fund to the unprotected funds, increasing what percentage of loss those funds would ultimately end up experiencing. If we go one column to the right, on the original tax bill, what we would have expected the debt fund to collect would have been $5.70. What we would have expected the general fund to collect would have been the $62.48. Of the 400 that came in, because the debt funds are protected, the debt fund actually experienced no circuit breaker loss. The $18 that we calculated on the prior page got proportionally allocated across all other funds, which ultimately, so what we're looking at is with the protection, it doesn't change how much circuit breaker loss a unit is experiencing. $18 was what the original calculation was, and $18 is how much loss was applied to this particular unit. What the protection did was make sure that the debt fund didn't experience circuit breaker while there were unprotected funds that could. So we've increased the circuit breaker to the general fund, and we have decreased the circuit breaker for the debt fund. Now, I want to put a pin. Oh, there's two things to mention. What we can see here is that the debt fund absolutely contributed to the circuit breaker loss, but did not experience any circuit breaker loss itself. It is part of the reason why there was $18 why there's $100 of loss in this tax bill, why there's $18 of loss for this unit. But when we examine how much circuit breaker loss was tied to that debt fund, because of the protection around debt funds, the fund itself didn't experience any loss. Okay. Also want to put a pin here for just a moment. We're going to revisit some of the limitations relating to protection later in the presentation, but for now, I want to transition to our third example, which will be the most complicated of the three that we're ultimately going to be looking at. The exempted funds, the referenda funds, whether they be, regardless of the unit type, whether operating capital or school safety, they are part of the tax rate, but they are said to be exempted from the circuit breaker calculation. Now, in the first webinar in this series, we took a look at how the property tax caps are calculated. Going down to the individual tax bill, using the gross assessed value, we could determine what the cap would be. Also, in that presentation, we examined in much more detail how when there is an exempted fund, when there's a referenda on that bill, how we will actively increase an individual's property tax cap to make sure that the referenda is fully funded, that the referenda cannot be tied to circuit breaker loss. We know that because we raised the cap. Everything else is underneath it. We increased the cap to make sure that everybody, the voters in that service area are actually paying every amount that they approve to pay. Where that's important is in our third example. Since the referenda rate itself cannot be tied to a circuit breaker loss, could not have generated circuit breaker loss, we are going to have to adjust our two-stage calculation for calculating how much revenue is going to be generated and how much circuit breaker is going to be applied to that individual unit. So in example 3, we're going to be introducing the concept of an exempted fund to our calculation, and we're going to slightly adjust how we handle step 1 and step 2. We're still going to figure out the units percentage. We're still going to figure out the funds percentage. But in step 1, instead of using the total rate, we are going to adjust the units rate to account for that referenda. We're effectively going to work the referenda out of the calculation. In step 2, we're going to go through that same process. While at the fund level calculation, referenda will be treated differently than all other non-exempted funds. Now, to put a pretty sharp point on it, if there is an exempted fund anywhere in the taxing district, that step 1 calculation is going to need to be adjusted. So it's not just whether or not you have a referenda. We're going to see on the next 2 slides how we need to adjust our calculation so that we're correctly applying any circuit breaker loss to all units within that taxing district. And so we're back to a 2-stage example where the top half of the slide is designed to show what would happen if there were no circuit breaker. And again, this is designed to just sort of give us a baseline. before that middle part where we really start diving into what happens if there is circuit breaker. And so if there were no circuit breaker, we can see that we would take the total taxing district rate, and for that school corporation, that is that's the red, that's the value in red, the 0.9972, which is the total certified rate, which would also include the referenda rate of 0.2552. So that 9972 includes the referenda amount. If there were no circuit breaker, that school corporation would represent 44% of the taxing district, so they'd get 44% of the distribution. And so in this case, I've increased the tax bill from $500 to $563, which means that the school corporation would, as representing 44%, would get 247. So that's our base example. In the example beneath it, let's look at how the calculation gets more complicated when we need to account for $100 of circuit breaker loss. So just like before, we started with a $563 tax bill, and now we're going to try to figure out how the revenue and the circuit breaker are going to be allocated if there were $100 of loss and leaving only $463 of actual property tax collections. First thing we're going to need to do is back out the referenda rate from the school rate. And we're doing that because we know that portion of the rate did not contribute to any of the circuit breaker loss, whereas everything else did. So instead of the school corporation representing 44% of the total rate, when we back out the 0.2552, the school corporation drops down to the only 37% of the rate. Now, we apply that 37% of the rate to the $463 that came in. It brings us back to $210 of the collections are going to go to the school corporation, and 37% of the $37 or 37% of the 100 are also going to go to the school corporation. Then now, again, going back to our base example where we're pretending like there was no circuit breaker, where there was an unadjusted $563 tax bill and $563 worth of collections that would have come in. In that example, the referenda rate would have generated $63, the debt fund would have generated $64, and the operations fund would have generated $120. If there were no circuit breakers and each fund generated as much as it could have absent of circuit breakers, this is what the distribution would look like. Now, if we take a look at our second example, where we introduce that $37 of circuit breaker loss, right, the $210 of collections and $37 worth of loss, we're going to go through a 3-stage process to figure out how much revenue goes to each fund and how much circuit breaker goes to each fund. So if there were, in the example that we've set up for the referenda fund, the 0022, we know that part of the units, rates did not contribute to any of the circuit breaker loss, would have generated $63. And so their adjusted distribution of the 210, 63 is still going to that referendum fund. In our second example, we've got a protected debt fund. We have a protected fund. We have a debt fund. Its distribution is still that same 64 that we saw in the original calculation. And so that leaves, if the 63 and the 64 have already been accounted for out of the 210, what that leaves us left is what's left for the operations fund. Because the operations fund is the only one that's not protected, it's the only one that's not exempt, it means it's the only unit that can experience circuit breaker loss for this. It's the only fund that can experience circuit breaker loss for this unit. So the full $37 of circuit breaker loss is ultimately going to be applied to the operations fund. Or to summarize, the referenda fund did not contribute to circuit breaker loss, nor will it participate in the sharing of the circuit breaker values. The debt fund, the 0180, did contribute to the circuit breaker loss, and we factored that into step 1. But in this example, it's protected from the circuit breaker loss, and so it also didn't experience any. And then which only leaves us with our operations fund, where it did contribute to the circuit breaker loss, and it's the only unprotected fund, so that's where the circuit breaker ultimately ended up going. So to bring it all back together, if we looked at all 3 examples, we started off with an example where With no protection, with no exemption, with no prioritization being considered, all funds experience circuit breaker at the same time. And then in the last example we took a look at, where we sort of built all of those concepts on top of each other, this idea of protected and exempt fund designations allows us to prioritize which funds, where the partial revenue that came in, how we prioritize which funds end up receiving dollars first. Let's take a look at a couple frequently asked questions. Okay, so we put a pin in an earlier topic where we were looking at the protection, or the limitations on what a protected fund looks like. Now, for a protected fund, we are going to apply the circuit breaker to the unprotected funds, but what happens if there is still circuit breaker loss after we've exhausted the protected funds? And that's the example I want to take a look at. I'll note that this is a hypothetical example. I have created this one specifically, so this is not a real unit in the state of Indiana. If we focus this time on the library, so if you'll picture that blue box one row down, I want to focus this example on the library. The library has a tax rate of the 0296, which means they're about 1% of the total. And on an unadjusted tax bill, they would have received $650. But in the example we keep going back to, where there's $400 of revenue collected and $100 of loss, the library is going to get $5.20 worth of revenue, and they're going to be we're going to work $1.30 into the step 2 calculation. When we start to examine the tax rate for the protected and the unprotected funds, the general fund has a tax rate of 0.0006, or makes up about 2% of the total, and then the protected fund, the debt fund, makes up about 97% of the total. So what the general fund should experience is about 13 cents worth of distribution. But there's a $1.30 worth of circuit breaker loss that the unit is experiencing. So what happens to the remaining circuit breaker loss once the protected funds are exhausted? The protected funds will experience circuit breaker loss. And so in this example, where the debt fund was originally expecting to receive $6.37, they're ultimately only going to end up receiving the $5.20, and the debt fund itself is going to experience $1.17 worth of loss. It is a protected fund. They are funds that are designed to not experience circuit breaker. But if circuit breaker gets bad enough at a taxing district or a taxing unit level, and there is not sufficient levies to offset that circuit breaker loss in the unprotected funds, protected funds can absolutely experience bucket circuit breaker loss. Now, considering what the debt levy represents, or the upcoming payments, if the circuit breaker starts to reduce the levy, will the unit be able to make their upcoming debt payments? And so one of the key metrics that the department will keep an eye on are units that are experiencing bucket circuit breaker for their debt funds. Frequently asked question number 2. And again, we're looking at an excerpt from the department's circuit breaker report, where we've got our debt service fund of the 0180. We can see on the far right that we have got a column that's marked protected, and what we've covered is that protected funds can experience circuit breaker, but they experience it after. What I want to focus on in this slide, is how the over 65 circuit breaker amount gets applied across the funds. Just like the bucket circuit breaker, the over 65 goes through a 2-step calculation, where first we figure out how much is tied to the unit, and then we figure out how much is tied to the fund. The difference, though, is that with the over 65 circuit breaker, it does not consider exemption or protection status. It treats all funds as if they were unprotected. So unlike the bucket circuit breaker sort of cousin, the debt funds and referenda funds may not be experiencing bucket circuit breaker, but may be experiencing the over 65. And so part of the reason why on the department's report that we're going to post annually, not only do we have a column that represents the total circuit breaker, we also have the 2 underlying columns that could potentially work together to fund that one. Or we have marked on this unit that their total circuit breaker impact is $7,590.13. But that didn't come from the bucket circuit breaker losses. That came from the box outlined in red, just the over 65. So we know that there are almost every fund experiences circuit breaker, but it's not the bucket circuit breaker that we've been evaluating through the course of this presentation, but it's the over 65 circuit breaker that we mentioned or that we covered in webinar number 1. All right, almost at the end here, just a few more slides. The $1 million question. All the information that we just covered, how can I use this while I'm budgeting? Now, we know that units are required to estimate what their circuit breaker loss is going to be as they are working through their budgeting process. While they'll still be working towards their maximum levy, what they are reporting during that process is an estimate of what portion of that they anticipate losing. It is a difficult estimate to make, but it's built right into the process. What I wanted to represent on this slide, or the example I wanted to come up with, is let's take a look at a hypothetical unit. Now, this unit has 4 funds, and the names of the funds aren't as important as the fact that none of the funds are protected, right? So this example covers a pretty large swath. In this example, we've estimated each fund has the same levy of $100, and each fund has the same tax rate of $25. When it comes time to estimate your circuit breaker loss, say that for the last few years, it has consistently come in at this $40 amount. So between CV estimate 1 and CV estimate 2, how do we account for $40 of circuit breaker loss as we're working through our budgeting? In CV estimate 1, we've taken that full $40, we put it right there on that top fund line. In CV estimate 2, we've taken the same $10 and we've estimated it proportionally across all funds. While both examples anticipate a total of $40 of loss, only one example takes into consideration the proportional nature of circuit breaker. And so when working on your budget, well, even if you were to incorporate the 40 in, if each fund that you are anticipating circuit breaker loss, if each fund has the same levy, then there is a high likelihood, it's not a perfect comparison, but there's a high likelihood that each unit would experience similar proportions of the loss. So in this case, CB estimate 2 would be more appropriate of an estimate than CB estimate 1. The second way that we can incorporate that into budgeting is one of the things that the department sees from time to time are units that are anticipating circuit breaker loss in funds that they're not currently levying. And so what we'll get is an example like the one before, but they'd have an anticipated levy of 0 for their rainy day fund, for their county highway fund, or for their school education fund, but they'll also have an estimated amount of circuit breaker loss of $100, $1,000, $1 million into a fund that didn't have a levy at all. And so the other way that we can end up using what we've covered in this presentation is for those units that you're not levying for, there's no circuit breaker loss. There's no possibility that fund could lose any property tax levy to circuit breaker. Now the third one, and again, the most complicated example, let's go back to something that was very similar to our first example. We've got 4 funds. In this case, we've given them very specific names. We've got 2 debt funds, we have got a capital referenda, and we've got an operations fund. All 4 have the same estimated levy. All 4 of them have the same estimated tax rate. 2 are protected, 1 is exempted, 1 is standard, one is unprotected. How would we apply the circuit breaker estimates in this case? Now, and we've set up CV estimate 3 and 4. In estimate 3, right, well, just like we covered, right? The rates are the same, so we should estimate the same. The rates and levies are the same, so we should estimate the same amount of loss. Estimate 4, we're putting all of that loss directly towards the operations fund. In both cases, we're anticipating $40 of circuit breaker loss, but only estimate 4 looks at the protected and exempted status is knowing that those funds aren't going to experience circuit breaker. The only fund that can experience circuit breaker in this case would be the unprotected operations fund. And so in this example, estimate 4 would be the more appropriate way to estimate or to work a circuit breaker amount into your budget. During the certification process, specifically during the certification process for debt funds, including capital referenda, if a unit provides the department with an estimated circuit breaker loss for those funds, we will remove it as part of the certification. The circuit breaker cannot be worked into the debt funds. And so in this case, example 4 would be the appropriate way to anticipate $40 of loss for this particular unit. Okay, that takes us to the end of the slideshow, the end of the slide deck. Thank you for attending. Hopefully this was hopefully this circuit breaker trilogy has sort of shined a little light onto a complicated topic. If you have further and follow-up questions, if you need assistance in understanding what the department is posting for your current year circuit breaker reports, would encourage you to continue this conversation with your DLGF field rep. They can take you through, they can explain anything that we covered during this particular presentation. It can help you to understand the documentation that the department will be posting, the reports that we're going to be posting, to let you know what your actual circuit breakers will be. Otherwise, thank you for attending. Really appreciate you sticking around for this 3-part presentation, and hopefully we'll see you at the next webinar. Have a good day.
Thanks, Fred. So just as a reminder, we will be sending out the webinar PowerPoint, the video, the survey, and the CE form, and we do appreciate all the feedback that you do provide on the survey. So we do take that as we're planning that for future webinars. So again, we will be sending those out to the registered individuals that were pre-registered, as well as posting on our website and on our YouTube channel. Those are all available. You can share that with others. You can get CE credit if you watch them at a later date. You just need to submit the CE form. If you have any questions, please feel free to leave it in the chat box or reach out to your field representative, and we will leave the window open for a few minutes following the webinar in case there's any last minute questions. But I want to thank all of you for attending today, and hopefully we'll see you next month. Thank you.